You just need some type of exogenous risk that hits the markets that all of a sudden causes these very high valuations to become problematic. But this is kind of the big thing right now is everybody's focused on these valuation levels. Like, oh, we've got these very high valuations levels. Yes, we do. And valuations are a function of sentiment. Right now, everybody's willing to chase. So yeah, valuations are high because sentiment's high. But the problem becomes with high valuations is that if anything that comes along that adjusts the expectations for earnings going forward, now you got a problem. What causes that? Who knows? It could be a variety of anything. But I think that's the big risk going into next year is you do have this valuation issue that potentially becomes problematic. Earnings expectations for next year are expected to grow double digits again. You've had very strong earnings growth, but most of that earnings growth, almost 50% of that earnings growth has come from 10 companies. So without those 10 companies, you didn't really grow earnings that much in the overall market. So if anything happens that all of a sudden Apple, Microsoft, Google, Berkshire, et cetera, aren't growing earnings, that's going to be more problematic for the market than probably just about anything else.
And correct me if I'm wrong, but don't they think that earnings will come from the other 490 companies this year?
They're expecting a 60% increase in small cap stocks this year. There's a lot of hope built into the markets going into next year. And look, don't take me and Mike wrong. We're not saying that the markets are going to crash next year at all. All we're saying is that there is a very high level of expectation going on for next year that leaves the market more fragile to disappointment. The markets aren't grossly overvalued and something goes wrong, you don't have big corrections. But when markets are very overvalued and you have a lot of sentiment, a lot of speculation, it makes the market more sensitive to even minor changes in outlook. A good example is just look at Oracle. The earnings were great yesterday. They barely missed on revenue and the stock's down 12% today. That's the break between what people were expecting and what actually happened, and that repricing is occurring very rapidly. That's the risk we take next year because of where the markets are.
Conversely, if valuations were very low, we wouldn't even care. If they were low enough, PEs have been in the high single digits. Mm-hmm. If we had a PE of 8 for the market, I'm not sure I would even care if we were going into a recession, right? Because you're getting them so cheap. We're at the opposite end of that spectrum. It doesn't mean the market can't keep rallying and valuations can't keep more, but what it does mean is you have to be on your toes and you have to expect that the market could correct, that valuations will eventually correct.
Catch me daily on The Real Investment Show. The link is in the description.